What do market volatility, new issue supply, and rising private credit defaults have in common? Hi, I'm Colleen Cunniffe. Today I'm breaking down what these changes mean for portfolios, positioning and risk, and how they're reshaping how investors think about credit. The markets are characterized by a lot of uncertainty, Uncertainty around growth, around the impact of tariffs, the trajectory of inflation, among others. Within that, our job as Vanguard Credit Research is to find the best risk-adjusted opportunities for our clients. Regardless of the market narrative, we are looking closely at the drivers of performance. Those are things like revenue, EBITDA, cash flow, margins. And we're looking at management's levers to influence those drivers of performance. Then we're looking to systematically incorporate those fundamental views into the technical market picture and valuation. We are looking for what we consider to be strong, stable sectors and issuers that generate good free cash flow. An example of that would be the utilities sector. Historically, a very stable sector, has some regulatory components to it that enforce that stability. They generate free cash flow. What that enables us to do is then move further down in their capital structure where we could take advantage of the opportunity to generate higher return, but do so within a risk environment that we're comfortable in the current market. Another example would be on the high yield side of the market. In that market, your biggest risk is the downside that comes when a company enters into distress. So we spend a significant amount of time at the offset trying to assess what those scenarios could be that could generate that stress and looking at what downside that creates. That makes it clear what we're entering into from a risk profile, and we can incorporate the current market dynamics into that and make sure that we are comfortable with the risk that we're taking. New issue supply into the market is an important consideration in both issuer recommendations and portfolio construction. There is a normal seasonality to the market, and September can generally be a heavy month. This year is no exception. This year, for the first day of the month, that was Tuesday, we had the second highest number of deals of all time and the second highest number of tranches all time. 27 deals in 60 tranches in one day. So very busy day for our team. And with the volume I mentioned, we were actually able to see average concession across the market of about 3 basis points on Tuesday. So this was a great performance opportunity. The fact that we are seeing rising defaults in the private credit market is not a surprise. It's a market that has attracted a lot of capital. It has exposure to smaller companies whose financial structures can have a more difficult time navigating difficult financial markets. There are characteristics of the private market that can mitigate the impact of distress and keep it from leaking out to the public markets. In particular, the interests of owners and lenders are aligned, and they have the flexibility to work with companies to give them more time and enable them to navigate through more difficult environment markets. So while we take comfort in the fact that there are some mitigants in the private credit market that will contain a distress cycle, we are also giving some thought to the potential ways a private credit default cycle could trickle out to the broader market. Two factors in particular: there are more public market participants in that market than there used to be, and there's a push for greater transparency that could impact the way information is shared. Both of those could, over time, impact the way a private credit default cycle impacts the broader public market. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.